Hi YouTube, it's the DIY Investing Guy channel. I'm Callum. If you're new to the channel, just subscribe to the channel, and if you enjoy this video, please smash that like button. Help get this help the channel grow and help get this video out there. Today's video, I'm just going to be talking about Nike and whether it's time to invest in this company. If you've already watched some of the videos on this channel, I do a regular portfolio update on my Freetrade account. And I'm currently holding 4 companies. I've built a decent position out in my Facebook and Tattooed Chef, and I'm currently buying a Boohoo and Alibaba, and I'm currently buying Boohoo and Salesforce. I do talk about them companies obviously in my videos because that's part of the portfolio updates and reviews on it. But obviously I'm still looking for great companies at a decent price, at good value prices. Nike's been on my watch list for a while now, and it's a quality company, and it's been hit by the effects of 2020 and the Rona last year. The price did crash last year, if you can see from the chart here. 16th of March was the lows of 67.45, $67.45. That was all the way back in March 2020 when the height of it was the start of the Rona, but it was like, that's where the market bottomed out there, and Nike obviously was affected by that. Nike's ticker symbol is NKE on the stock market. It's traded on the New York Stock Exchange, and I'm just going to go through a bit of basic outline research of what I've done in the company. Everybody knows what Nike is. It sells sporting athleisure wear, from tracksuits to t-shirts to shorts. It's for athleisure wear, for general casual wearing, and for sports as well. And obviously it's quite popular with its trendy trainers, from your dads wear them, you wear them, children wear them, girls wear them, boys wear them. It's quite a diverse company, and it caters to all sorts of it caters to everyone really in terms of sports fashion and stuff like that. It does sell to a lot of third-party retailers. It has a lot of exclusive deals with certain retailers, but it is starting to open its own stores and sell for its own lines of channels, which will improve its margins going forward in the future. So yeah, back in March 2020, the price dipped to 67. So I'm just looking now to see if I've missed out on the opportunity. It is a great company. Obviously 2020 wasn't the best year for it because it was, its production lines, because it still has to it manufactures its own clothes, so that was affected by that, and it could, it had to close factories and stuff, probably most likely, and it had to probably production was halted on its lines because it is a manufacturer of sporting athleisure wear, not just a retailer. So yeah, even if you could sell it online, it's still got to make the goods to sell online, and obviously fashion is constantly moving. Sorry, pardon me. So yeah, so I want to see how 2020 has affected it, whether it's still a bargain price, whether I can, buy into it, because I'd love to own this company, but I won't pay an infinite price for it. Trying to be a value investor, but trying to look for companies that have got decent growth. So yeah, that's basically what I've looked at. This is the past year five-year graph. So 5 years ago, it was trading at $54 a share. Now that was a great price. That's a great price to get in at, really. And now it's roughly about 150% up over the last 5 years. So it hasn't beat the market or beat there's other stocks that have performed better stock price wise, but I'm looking to invest in quality companies for a long time. I've got a long time horizon, and the more confident I am in the company, the more money I'll invest and the bigger return I'll get. It's not just about the percentage return, it's about the actual money you make on your investment. So if something like skills or something like that, which I like it as a company, I'm not willing to whack 20% of my portfolio into that. So when I bet big, I want to bet big. So the company's got to be good and it's got to be at a decent price, and not fits them categories. Now I'm just going to try and work out if the price is any good. This app that I'm using at the moment is Yahoo Finance. I find this is a great tool. Obviously, I use Freetrade for my investing into my single stocks, and the tools that are there aren't the best, but you've got all these online tools like Yahoo Finance and Simply Wall Street, which I'll be going through in a minute. So you don't really need to be using Freetrade to do your research and stuff like that. You can just use that as the broker. You've got all these online tools. Back 20 years ago, you would have needed a decent broker and decent information to be sent to you, but these days you can just get it all on the internet, and Yahoo Finance is a great a great source of information and research. So if you look at all these, you can get all these key statistics there. Its PE ratio is currently 61. That's its trailing 12 months. I think its forward PE ratio is around about 30. So it's not horrendous. What I do like about this company is it's got a PEG of 1%, and its dividend yield is currently just under 1%. So PEG ratio is price to earnings and growth. So it's your price to earnings ratio over your growth. So anything below 1 is generally seen as good growth. It's beat its last two earnings calls. It's analysts are mixed on it. It's hold buy or strong buy, so it's not an outright buy. It's got a high innovation score, which it takes into a look at consideration on all things considered, and it just works out what its innovation score is. And you've got your news articles on it and stuff like that. But I'm trying to look for. Yeah, we'll have a look at all the key statistics here. So yeah, like I said, its trailing PE ratio is 61, but its forward PE ratio is only 33, and its expected 5-year PEG ratio is 1.03. So that's a massively good sign for a decent growth company. Price to sales is quite high. Price to book, nothing to write home about there. But there are factors in that. I think it's took on a lot of debt, which I'll go through in a bit, like we had to Simply Wall Street in the last year, to cover its operating expenses, because obviously it's got fixed costs it needs to cover last year, and obviously with the revenue decrease, for obvious reasons that we've spoke about already in this video, it's got a bit of debt, so that might be holding the stock back a bit at the moment. But we'll have a look, and I'll obviously do a valuation on it at the end, and I'll show you Simply Wall Street's valuation on it. So here we go, it's 52 weeks highs is 150. Now this is why I'm looking at the stock, because I don't really like to buy at 52 week highs, and it's not trading at 52 week highs. It's currently trading about 130, so it's $20 off its 52 week highs, but it's still $40 off its 52 week lows. So maybe $90 is maybe looking at a starting position in this stock from what I've seen so far. It's moving average. So the last 50 days, it's trading at it's roughly its moving average, because it's currently trading at $131 a share. And it's not that far from its 200-day moving average, so it's not a very volatile stock. So what we're looking for here is a bit of a dip in the stock price at the moment, and then hopefully we can start a position in this company. But obviously I want to make sure that I get it at a really, really good value price. There's a few things here that aren't really that important. It does pay a small dividend, but it's nothing to write home about. It's 48% at the moment. And then it's profit margins, operating margins, 11%, not bad. Return on assets, return on equity, the trailing 12 months is amazing, 32% is good. Return on assets is okay. So it's revenue, 38.51. Revenue per share, $24.57. Its quarterly revenue growth is 2.5%. And its EPS is, so that's every share that's out, like, there's the company split up into so many millions of shares or what, and every share is only $2.14. So if you buy a share for $131, it's earning you $2.14 a year, and you want that to increase over time, which will give you share value increase over time. And quarterly earnings growth 71%, which you can see coming out of the restraints that have been forced upon retail industries and manufacturing industries over the last 12 months, 16 months have come out now, and in the last quarter it started to tick up its earnings growth. It's got 12.5 billion in cash, and its debt's 12.85 billion, which is a lot at the moment. And then its cash flow, its operating cash flow is 4.64 billion, and its leveraged free cash flow is 4.12 billion, which means it's got its cash flow and obviously money that's borrowed. Yeah, so those are the key figures on Simply. Let's go back on that there. Simply, no, this is on Yahoo Finance. So if we go to details, yeah, this is a decent one here. It to show you its performance. It's just historical. It shows you the top holders of this company, and there's a profile for the company. So yeah, it's all pretty. Get some show all analyst data. So you got your analyst expectations and stuff on here, and why they're recommending to buy and sell. So if you need anything like that, Yahoo Finance is a great guide to go. And you can obviously see show all financial data. Here it is. This is what I was looking for. You've got your income statements that you can look on here. It's all pretty. At the bottom you can see 2017. It's not on there, but annually it's, you know, its revenues haven't really increased in the last, but I think it's increased slightly from 2018 to 2019, and then 2020 it's down a little bit, but that's, you know, it's for obvious reasons. I still think it's going to improve its revenue and its earnings over as the years go on. But it's a good company. It's a solid company. It's got a moat. It's got a brand moat. It's got a quality brand moat. In fact, I love Nike clothes. One of my favourite clothes. That and Adidas, right up there. So it's just a beast of a clothing brand industry company. So yeah, so that's its, you know, its revenue and stuff and its earnings. So you can see that in a nice graph there to analyse a company. Then you got your balance sheet, which will give you all your, you know, a snapshot of how the company's looking. And again, it's the same stuff at the bottom there. And this is quite important. I always like to look at the cash flow of the company. I always like to see if it's growing, so you can look at previous years, you know. And it's free cash flow. After capital, operating cash flow is 4.6 billion. Yeah, because this is in thousands. And it's free cash flow after capital expenditure. It's still nearly 4 billion, 3.8 billion. So it is a beast of a company. And it's expected to beat its last 3 quarters. Obviously, it missed Q2 2020 for obvious reasons that we've laid out. That's probably impacted it quite a lot over that year there. And then obviously, I expect it to beat its Q2 for 2021 is quite low. And I think that's based on last year's Q2. So the expectation is quite low. So I think it's going to absolutely smash Q2. You know, it's coming up this month now. June the 24th is when Q2 will be announced. So I think it's going to smash the expectations on this. But normally, if it has a good, you know, I think it's going to have a really good Q2 trading update. But normally, as you'll see, if it has a good trading update, the stock price normally falls on any company. So hopefully that might put us in the buying opportunity and get us around about that $90 mark if it's 52 weeks low or lower even. So then this is Yahoo Finance. And you know, it's a great, you can look up any stock you want to that's listed on the stock exchange, on any stock exchange in the world really, on Yahoo Finance. So you might not even offer it in your brokerage account, but you can still look it up on your on Yahoo Finance and do a bit of research into a company that you're interested in. And I'm definitely interested in Nike. And then let's just go, here's Simply Wall Street. Move the icon here. Yeah, Simply Wall Street here. So this is an app I use, and it's a quality app, and it does a lot of the research for you. I still do my own research, but it just a help and a guide, and it helps me work out the valuation of a company, and if it's, you know, it highlights potential risks in the company. It's a great app to use really. I found it a couple of years ago, and it's really helped me validate some of my investments, stop me investing in certain companies that, you know, I wasn't 50% sure about, because you can do all the research in the world, but, you know, once you visually see in black and white, and the way it's laid out on Simply Wall Street, it's amazing. So yeah, so obviously it just gives you a summary of it. Nike, together with subsidiaries, designs, develops, markets and sells athletic footwear. So it has like its own ecosystem, so it does the full shebang. You know, logistically it makes them, packages them, sends them, sells them, does the whole lot. And it's just a world-class company. It's Simply Wall Street has got its earnings to grow between 14% a year, which is a good thing. 14% is not a bad earnings growth. I think it's going to grow anywhere between 10 and 20% a year, even for the next 10 years, because it's such a phenomenal company, and it's got such strong pricing power with its because it's got a brand moat. It's got its own networking moat, so it's got such good pricing power. I think it can sustain its growth. It's a sustainably consistent growth for the long term. Obviously, as a risk I've outlined earlier, it's got a high level of debt, which obviously I'll be going through. And obviously, there's a chart on Simply Wall Street that shows you where it's took its debt on, and I think it's obvious reasons why it's took its debt on. 2020 as a whole and Rona was the two main reasons it's took a lot of debt on. It's sort of, this is a snowflake graph that shows you which is great for it. It's a healthy company, it pays a dividend, and it's got a bit of future. So what it's saying, it's not a value stock, because obviously it's not a value stock, but sometimes if the price of a stock is that beat down, even if it's a growth stock or a whatever, I don't really put labels on stocks. I just look to buy quality companies at good prices. Like Warren Buffett, like, you know, Terry Smith of Fundsmith. Just look for quality companies and get them at a cheap price. Fundsmith actually brought this in Starbucks last year, but they brought it at the, you know, around about the $70 mark, which is a good starting position price. So yeah, I'm just seeing now if I've missed the boat. I'm not just going to pay anything for the company, even though I do love this company. Obviously, this is competitors, similar sort of competitors. Apple's on there, but Apple is a brand in itself. That's a share price chart. I don't really like that share price chart. It's giving you the 7-day return, the US luxury market, US markets, and no, it's not really performed well over the last 7 days. But, you know, we don't invest for 7 days, we invest for decades even. So 1 year return's pretty good on Nike, but like you said, the price was pretty beaten down like 15 months ago, 14 months ago. So 38% return, which is, you know, an amazing return in 1 year. And it's pretty much kept in line with the US market, just about beating the US market and the US luxury brands market. It's just there and thereabouts. So it's just gone up with the market, really. And it is a pretty big company, so it does tend to follow the market. And obviously you can see the 5-year return here, about 160%, which, you know, that's including a dividend return. And 3-year 80%, and 1 year 39%. So yeah, it's a pretty solid company. I just think you've just got to look for the right time to buy into the company when it's on a dip, because the 40% in the last year share price would have brought all these other years up. In, you know, 40%. It's probably not had a 40% year that in the last 5 years. It's probably been its best year in terms of share price performance. But obviously, it's got compounded growth there as well. So yeah, it's quite low on the volatility chart. Like I said, it hasn't really moved about. It's lower than the industry, and it's lower than the market volatility. So the S&P and 500 will move up and down more than Nike has over the last 3 months or so. Some articles on Nike. You just download the simple Wall Street app and you get all this. Price to earnings ratio 60 is quite high. Like I said, this is the trailing 12 months. The forward PE ratio is about 30 for the next 12 months. And then here you can see in black and white what Simply Wall Street, with all its data all put in its system, it thinks that it's overvalued, and it thinks it's about 40% over, and it thinks its fair value is about $94.57 a share, which is its 52-week lows. All right, you know, coincidentally. But yeah, so if you get that, it's fair value, but we don't want to be buying it at fair value. We want to buy it a bit cheaper, so we've got a bit of a margin of safety in case anything does go wrong, like last year, for instance. Just because it's a massive company doesn't mean that, you know, outside things can't affect it. World events can't affect it. So you want to be buying companies a bit of a margin of safety. Obviously, this shows you the PE ratio, price to earnings growth. It's different on this one. They're not. I think Yahoo Finance is a bit better for its information in there. Price to book's the same. Yeah, it's quite high. And its growth is forecasted to grow at 14% a year, and then you can see. Here's a graph of its revenue and its earnings, and then also back free cash flow in there and cash from operations, which pretty much sort of follow the same curvature as the earnings. And obviously you can see here from revenue and earnings, you can see it's going up nicely and steadily. And then last year, 2020, it took a dip. It consolidated, and then it started to. It's now getting back on track, so it's going in the right and. Up towards 2026, it's going up in the right direction, which is a good sign. And obviously, if it's $90 a share, that's fair value, that's a decent price. But obviously, you can see from this chart, it's going up nicely, but it was also going up nicely until this happened. So things do happen, events happen in the world and in the market that, you know, all company specific. You know, that's why you want to be buying at margin safety for when these events happen, so that you've got a bit of leeway to, you know, still make your 15% return every year, which roughly doubles your money after 2 years. So you don't want to be paying too much up front, because things can affect the stock price even 3-4 years down the line. Also, these events, obviously here, like here, And as you've seen, like when I show you the chart, there's an opportunity to buy the stock at a cheaper price there. So events sometimes can be a buying opportunity if you're just patient and build up your cash positions. But it's always good. That's why you have a watch list and you're constantly watching what stocks are on the watch list. So yeah, I think, yeah, so that's basically, you can see it's back on track now. And a big company like Nike, you'd expect it to get back on track after the dust had settled and stuff like that. So I think, yeah, we're looking for decent growth, but I'm still not completely sold on the stock price at the moment. But I love the company, just not the price at the moment. Obviously, the company, the industry, the market, these are all pretty generic. They're pretty similar. Next year, the industry, analyst future growth forecasts. These are just future estimates and forecasts. They're not set in stone. And then obviously it gives you the pros and cons of all that sort of stuff. The EPS, obviously you can see the dip again in the same year there. Return on equity over the last 3 years is 48%, which is an absolutely phenomenal figure for any company. Just amazing numbers. It does give out some great numbers. And then this is all like revenue over the last five years, earnings, free cash flow, operating expenses. Operating expenses has been, even with the dip in sales and revenue last year and profit, the operating expenses still stayed pretty much the same. So that's why it's probably took a bit of debt on, because you can see the dip there. But the operating expense, but there's no dip. There's a dip on the bottom line and there's a dip on the top line. But on the operating expenses line, there's no dip. So you got your sales on the top line. You got your operating expenses, like your cost of, your bills, your staff, stuff like that. Your fixed costs, they pretty much stayed the same all the time. And then your bottom line is your profit, your gross margin profit after, taking out all your fixed costs. That's dipped as well. So that's why they've probably had to take a bit of debt on last year. Nike has high quality of earnings, which means it generally converts most of its earnings to cash, which is a good thing. Past earnings growth, so it's down, but you can understand most of this. It wouldn't be down if last year wasn't such a down year for it. So it's lost a lot of. So this is the past 5 years, but then this is the past 1 year, 20% down. So that's obviously, it wouldn't be down for the past 5 years if it weren't for that last 1 year. But that's what I mean by making sure you get in at the right price, because even 3 years down the line, something could happen that affects the share price. Return on equity is 28%, which is considered good. That's high, which is good. Return on assets 10%. Return on capital employed is 16%, but 3 years ago it was 25%. And also we can put that down to world events and Rony last year, really. So yeah, financial health, it's got 2 crosses, but like I've said, like, it took on a bit of debt. It was debt light until last year, and obviously it's got plans for future expansion, and it's looking now to sell, rather than through exclusive deals with retailers, it's looking to sell its own products direct to consumer online in stores. So that's going to increase its margins and increase its growth exponentially, in my opinion, in the next 10 years. So even a big company like this can still have some decent growth. It's just getting it at the right price. I keep on banging on about this price, but if you're doing your due diligence on buying a house, you'll send surveyors in, you'll work out whether the house is safe to live in, or damp, water damage, anything like that. You'll send surveyors in, they'll do a check of the house, and they'll give you a fair value on the house. Now, if the seller of that house, say that someone comes out and says the fair value of this house is £150,000, and then the seller wants to sell it to you for £250,000, you're going to tell them to do one, and you're not going to buy the house. So it's the same with stocks, really. You have to do your investigations, your due diligence, your research, work out the price of a company, and the future price of the company, because obviously there's a profits and stuff that is built with a company that you don't get with a house. So the future, so that gives you a fair value of what a company is worth, and then you try and buy it for like half the price of that. Haggle it, you can haggle someone selling you a house. You cannot haggle the stock market. It just all depends on how the market's feeling on the day. And obviously, there's in Warren Buffett also, there's a book where it calls him Mr. Market, and I think it's Benjamin Graham's book, The Intelligent Investor. Mr. Market, he can be having, he's a manic depressive. He's got bipolar. Some days he'll be giving you bargains, 50p a share, and then other days he'll be charging you $100 for the same company. So you've just got to wait and make the right decision. it's about emotion as well, like staying holding on when the stock's going up and down and stuff. It's about the long term, not the short term. So I've just gone on. So yeah, so as you can see, back to Nike now. Its assets short term outweigh its liabilities. Its assets to its liabilities long term. It's not as great as you'd want it to look, but it'll cover them because it's got plenty of cash coming from its operations. And as you can see, the equity of the company, which is all the cash and what it owns and its assets. The debt, it's always had a little bit of debt, but it's always been well covered. And then last year, obviously, it won't generate as much cash, and the debt's gone up a little bit. So the debt was actually over the equity for a while, but now obviously it's sort of the dust has settled, and Nike looks like it's coming out the other side now. So yeah, there you can see, and it's 2020, the start of 2020 there, when you could have got the share. See, sometimes when a company's in distress, it's the best time to buy it because you get the best price for it. So you'd have pretty much if you'd have brought in at the lows in March, you'd have pretty much made over 100% on your money now, just by buying in then when it was a distressed company and it's back on its feet. I mean, people were saying, well, the world's over and stuff like that last year. But, if the world really was over, what was the army taking a punt on a quality company that's been around for decades? And if we did come out on the other side as the world, we come out, got through the horrible year that was 2020, that, putting your money on not doing quite well afterwards, it wouldn't be a bad shout, would it? Now, all these doomsayers and gloomies last year that were like, oh no, get out the stock market, the whole economy is going to go. But, well, you might as well throw your money in, because if that's the case, then we should all just give up and stop going to work and stop breathing, if that was the case. So just a bit of positivity, and just thinking about the future rather than just the immediate future. You could have seen that Nike was going to do pretty well. There was quite a few companies, Greggs, they were written off, Nike, Starbucks, but these are Disney even. So these are brands that were going to come out the other side. So you would have made over 100%. And there was a lot of money to be made in the stock market last year. And to be fair, I wish I'd have been a bit more confident in my own thought processes and didn't second guess myself so much, and I'd have made a lot more money than I did last year in the stock market. But hey ho, it's the way it goes, and I've learnt valuable lessons from that over the last year. I did have a good 2020 in terms of the stock market, but could have had a lot better. There was a chance to buy quality companies like Nike, Greggs. Even Coca-Cola was trading at a cheaper price in March 2020. It was a chance to buy some quality companies and get into some decent prices with a decent position side if you've had the cash on hand. And you could have made an absolute ton of money and been just let compound interest do the work for the future. But yeah, so this is a long video. So here it's just a quick look at the balance sheet in terms of a visual on Simply Wall Street, which is great. You got your physical assets. You got and then you see there's a little bit of debt now. It's probably smaller last year. It's probably about half that size, but I think it will get its debt piled down with how quality it's got quality earnings and its profits to cash conversion, and it's in terms of it actually gets the cash for the product, whereas some companies, they put it down as sales and they put it down as profit, but they haven't actually converted. It's not been converted to cash because they haven't had the payment for it yet, but they still put it on their account and stuff. Its dividend yield 1% again. A lot of this has been rehashed from Yahoo Finance. So yeah, it's looking to get a lot better now with its dividend. Looks a lot safer for the future. And then obviously you can see the management. So there's a bit of research to the management. He's not been with the company that long. Check the CEO compensation, which never really bothers me in all fairness, as long as the company's doing well. See the leadership team, what they're paid. And then you see the ownership. No one's really bought or sold any shares. You can see insiders selling over the 3 months, 6 months, 9 months, and a year on here. And then it breaks down the company to individual investors. That's you and me. General public. That's you and me. Individual. So it's only 10% is the general public. Individual insiders. That would be CEOs and even people that work in the company. Private companies, public companies hardly own any of it. And institutions. It's mainly owned by fund managers, pension funds, pension accounts, but things like that own this company, and trusts and stuff. So it's nearly 68% of it is owned by institutions. and these are the top holders of it. So Philip Knight 17%, Vanguard, BlackRock, Travis Knight, Capital Research, and General Management. See, the little thing means that these are individual insiders. Philip Knight and Travis Knight are, and the rest of the top holders are pretty much institutions. And there's your bit of company information, when it was founded and stuff like that, and that's the whole lot for it on Simply Wall Street. So yeah, you know, there are tools out there to help people that aren't, you know, I've learned a lot from reading books and doing my own research and stuff, because I'm into it now, a stock market geek really, and I've learned a lot. But there are tools out there to help people, and this really helped me when I got started Simply Wall Street. I've only just recently started, you know, like the last 12 months using Yahoo Finance, but I've been using Simply Wall Street for a couple of years now, and it's made me sometimes it's made me a decent amount of money, because I've looked at it and I thought, oh, this is quite undervalued. Now I've worked out how to value a company myself and, you know, do my own research, but I still like to look at Simply Wall Street and Yahoo Finance as point of reference, and just to validate my own thoughts, as do watching other YouTubers and what they think on certain stocks that I'm interested in. But that doesn't mean just because a YouTuber said buy Tattooed Chef, or a YouTuber said buy Palantir or whatever, or anything like that, I'll go and buy it. Or Simply Wall Street says that it's 50% undervalued, I'll go and buy it. I still do my own research so that I'm happy with the company. And even Simply Wall Street can get it wrong sometimes. Even Yahoo Finance doesn't really give you valuations, but it just gives you all the information you need to do your own research and calculations. That's pretty good for it on the year half. But this sort of does a lot of the research for you, Simply Wall Street. But I'd still say do your own research, because, you know, if you're investing a large sum of your personal savings into companies, then you need to make sure what you're investing in and that you're getting it for a good price. And then finally, here's a little valuation I've done myself on the company. And obviously I've worked out what the 10-year EPS is using the 15% growth rate, which I think is fair to say with a company like Nike, sorry. Its P ratio is currently 61, like I said. Obviously the prices on here might not be as accurate at the time of this, but they were, at the time of making, they were accurate, so please do your own research. Share price is currently $131. The EPS is $2.14, and the minimum rate of return I want to get on a stock is 15%, so it's always 15% that I want to get annually, which doubles my money roughly every 5 years. So the 10-year EPS, I've times it by 15%, and I do that 10 times the EPS, and it gives me about $8.66, which is fair. You know, I think that's fair to say. It'll probably be around about $8.66 for Nike in another decade's time, around the 2030 mark. So then the 10-year share price is what the EPS would be in 10 years. Sorry, talking for 32 minutes here. And I times that by a P ratio of 25. I've always used 25, building a bit of margin of safety. That's the sort of P ratio for this company. It's a growth stock, not really a value stock. So yeah, 25 is a good P ratio for a company like this. Not the 61. I'm not using the 61. If it is at 61 P ratio with these numbers in 10 years time, you know, it's going to be a huge 10 bagger, multi-bagger potentially if you brought in at these prices now, but you can't be sure of that. So it gives me a share price of about $216 in 10 years time. So then to get my current price, but I want 15% return, I divide it by 4, because that's roughly 2 doubles in 10 years, and that gives me $54.12. So like, say what last year would have been an ideal getting point in March time. I can't really see it getting down to $54. I mean, I'd start around about the probably $70, $80 mark. I'd want to start a position, and then if, you know, for whatever reason I could get it averaged down, I would. A margin of safety price, then I'll divide it by 2, and it gives you an absolute bargain price. But if you got in at this price, you know, you're 10 times in your money in 10 years time, $27.06. You roughly, you know, it's roughly a 10 bagger in 10 years time, then a multi bagger, maybe an 8 bagger. So yeah. But it also gives you a bit of margin of safety. You know, if something went wrong with Nike, now if you've bought in at $27, you're still going to be sitting on a tidy profit there, and you're more likely to get your 15% rate of return. That's going into margin of safety overkill, I think, there. But yeah, that's pretty much what I've got to say on the company. It's a quality company. Everyone knows what Nike is. I hope you've enjoyed this video. It's been a very long video, and yeah. if you could all just subscribe to the channel and smash that like button, help the channel grow, that would be much appreciated. There'll be some links in the description of this video to open a Freetrade account, deposit £1 and get you start your investing journey and get a free share between, you know, fill out your WE8 form or whatever it is on there, and you'll be able to get a free share between £3 and £200, which is a great way to start investing. I hope you've all enjoyed this video. Have a nice day.